What's up, everybody? Let's see some earnings here. Bill pins lower after hours. Bill earnings per share beat. Raised guidance. BILL. What? Oh, take two was the other one. Take two guided lower. Take two. Interesting. What happened to the degenerate game? Anything else interesting on here? Oh, where's a firm? You guys were looking for a firm, right? A firm. Oh, there it is. Beat on the firm. Net. Oh, net. Yeah, net. I posted right. Net's up. Let's see. Net. Where is she? Net. Oh, must be up nice here. Yeah. Yeah, net did look interesting. Ranchero liked the net too. Back to $100. Um, what's up, T? How are you? Affirm. Oh, affirm down. Look like they beat and take two lowered guidance, so they're going to be down. Not down much though. That could be a nice bounce candidate tomorrow. Hold on, let me mute some stuff here too. All right, and let me get this. Oh, here's net. Net sees fiscal 24.58 cents, 59 cents versus 54. So they raised guidance there too, net. All right. I wanted to show a couple charts. Let's see what we got here. We got this. Oh, the other chart I want to show here too. Hold on.
Yeah, Lamplarin ET up about 20% after reporting better than expected results, 15 cents for earnings, 3-cent beat on revenue beat as well.
What the fuck? All right. I just wanted to show you guys a couple of charts. We'll talk. We'll talk a little bit about McElliott too, who's been right on the money. I think it's not like anybody has a crystal ball in this game. You guys know I don't believe in any of that shit. But McElliott's on a very similar page as far as trying to handicap this game that we are. Right? Looks at a lot of positioning stuff. More so on the VIX side and option side. And pretty sharp at what he does. So we always like to pay attention to any of his calls with conviction. Let me. Okay, I could always go back here and post. All right. All right. So listen, I mean, the market's been a lot of fun. Okay. I think it actually helps that it's not the whole market doing what the semis are doing. The one thing that's becoming a problem are the semis, meaning it doesn't mean they can't stop going. I mean, they stop going higher from here. Obviously, we've anybody who's been in the market knows things can look overbought or have run too much, and they keep going. I think SMCI is up 15 straight days or some shit like that after doubling already. So when you get when there's such underexposure on the positioning side, and you just get a complete flip flop um, as far as the macro backdrop, right? So you had a Fed that was going to be higher for longer, and which was going to weigh on tech stocks and weigh on high multiple names, and you want to buy the banks, and right, that whole playbook got completely flushed down the toilet bowl. Right, so anybody who was bullish was positioning for a completely different animal than what we're seeing right now. We talked about going into the start of 2023, how much tech was underowned, and the semi specifically were the most shorted sector on the board, literally at the start of 2023. Right, when you get a complete flip flop of a narrative like we have now, this is what you see in price action. Right, not always do you get that flip flop. Right, sometimes when players are positioned for something, you get news in the other direction, and you get that scramble and squeeze. Here, you got just the complete opposite of what people were looking for, right? Everybody looking for a recession, looking complete opposite. And now, and we've been talking about this, for multiple weeks now. The narrative that's out there, and if you think of it logically, right? What what needs to happen to squash this narrative? Okay, there's a lot that needs to show up, some meaningful stuff that needs to show up to really squash this narrative. You have, like we were talking about this morning, heads you win, tails they lose attitude, where you have the Fed and the Treasury, and let's just blatantly put it out there, right? Trying to prop up the market, the economy, rig the game, the complete opposite of what they were doing in 2022 to combat inflation in an election year, right? And I think that's the most important thing to understand here, because without understanding that, none of it is going to make any sense. So you have an election year where um, the players, the outfits that were a burden on the market are now beneficial to the market, right? You got looser financial conditions. They're working now as a tailwind, right? Again, the complete opposite. You have liquidity working as a tailwind, the complete opposite. So the attitude behind funds and players out there that really have been sitting on cash and are underexposed are to revamp, right, some risk, put back some risk. And what we were seeing happening prior to recently, and something else we've been talking about, they focused on quality initially, right? And as that quality basket started to broaden out, which was a healthy sign, it went from just the Magnificent Seven. Then you started to see some semiconductors out of that group. Then large cap tech like a Now, or large cap like a Costco, right? Though any name that was profitable and showing growth, funds were crowding into. Okay. Now it's got to an extreme, right? Where you see a name like ARM, a semiconductor that beats earnings, whatever, raises guidance. And because it's a semiconductor and one of the few that hasn't absolutely ripped yet, the stock goes up 60, 70% off earnings, right? So you get that frenzy, okay? And not to bounce around, that going back to like McElliott, who we've been talking about, and that's why we kind of, you could see this happening from where we were last year, right? Without something entering the picture, right? That exogenous event, right? And it doesn't have to be a nuclear bomb, but something that kills that narrative, gets people concerned enough that they get to the point where, oh shit, we don't have protection, we don't have insurance, we need to get aggressive and start buying VIX and shit like that. Unless you get that, this whole theme of adding risk and adding exposure continues to build, right? And that's kind of what we're seeing now. And we're seeing the crowdingness really get to an extreme now, to the point where, and McElliott's note kind of touched on this earlier today. Anybody, even if you were expecting it, right, or even if it was a scenario you saw that could play out, you're starting to get concerned, right, when you see this type of price action, the aggressive behavior behind this crowding positioning we're starting to see. Now, what's interesting again is that it's not in a lot of the market, right? It's in a larger chunk now since the market has broadened out, right? You talk to Perma Bears, you would think just 7 stocks were going up. That hasn't been the case for a while now, right? Little by little, it's been broadening out. Now, I'm not going to say breadth has been super, but it's been a lot more than 7 stocks that have been ripping in this market, right? I can name 50 off the top of my head right now. So even though it's it's there's more names involved in this rip, okay, you still have a lot of stuff out there that hasn't participated as much. Okay, so I bring that up because it's interesting that if there happens to be some sort of catalyst that shows up over the next couple of weeks, let's say, and you get that violent sell off, even if it's just that week, let's say, I still think it could be a really healthy reset to where you could possibly, off that reset, even see a broader rally, more participation in the stuff that didn't participate, right? But if we see this continue, if nothing gets in the way of this narrative, as we get through Feb OPEX into March per se, or into the end of February, I think it could become very, very dangerous. Again, I don't have a crystal ball, but what's gonna happen is I can see it now where you get the Russell gets involved, the financials get back involved, everything is beautiful again. You don't have the regional bank issue, right? Now you got that full participation where breadth looks better, but everybody now is officially off sides and in the pool, right? And that's the most dangerous outcome, possibly, out of what we're seeing right now. So, to the point, I think we got to continue to take it week by week as we've been, and still react rather than try to predict, right? The tough part of this whole entire market, and you could go back to the bearish trend we were in 2022. It's been a lot easier to react than to try to predict what's going to happen, right? Yeah, you miss some of the move. Okay. You may miss a big part of the move, but you see what's happened to people who try to whip out their crystal ball and forecast how any of this shit was going to shake out, right? Completely wrong. Again, even the bulls, which had a bullish case on their plate, have been wrong in the things to own in the rally, right? So I still think the smarter move is to react, right? And you got to be a lot more nimble. You got to be a lot more tactical. And yes, maybe you don't catch the whole entire SMCI move. Yes, maybe you don't hold an arm through earnings and miss that move. But I think you avoid a lot of risk that comes with it, with this whole extremeness that we're seeing right now at this point. Okay. So again, if we take it week by week, right? Let's see. Ooh, what did I do? Let's see where we're at right now. Because this, with without something showing up. So McElliott named a couple things. And a lot of times it's something you never could foresee that tips the scale, right? Something that comes out of nowhere. Hence the term exogenous. But you have a couple things, possible catalysts that can get in the way and maybe squash the narrative, right? So McElliott talks about NVIDIA earnings, right? If they drop the ball there, or even just a sell the news catalyst where it gets the momentum going in the other direction, and you have a lot of money in crowded areas heading out one door, right? A positioning extreme and everybody looking to sell at once. That could be a potential catalyst, right? So you got NVIDIA earnings in a couple of weeks. Um, Before that, well, he also talks about the banks. Okay, for anybody, maybe some of you aren't even aware of what's been going on because the market and the semiconductors couldn't give a rat's ass about what's going on in the regional banking sector. But you have a name like this that's been smashed and littered with put action, right? Not a whole lot of things catching put action these days. But this is a group that they've been sweeping puts on really all week, even some last week, and continue to do so. And yeah, NYCB won't necessarily be an issue that can kill the narrative for what we've been seeing on the Buller side. But if there's something larger behind the NYCB, meaning there's more out there, more problems that we're not aware of course that can. Okay. To that point, we like to look to the credit markets, right? We look at spreads and swaps to get an indication. A lot of times they'll tell us, even if it's not really early, in real time, they'll tell us if there's any issue the credit market is concerned about. Nothing. Zippo. Right. So as of right now, today, what's going on with NYCB, the credit markets aren't showing a lick of concern. Okay. But again, McElliott lists that as a possible scenario, which it still could be. Um, Aside from that, you have next week is OPEX week, and you got expiration for VIX as well. Okay, and that's kind of where McElliott is showing some concern. You see what they do to VIX every single day, right? Smashed every day. Okay, and VIX sellers, you know, are getting extremely cocky. Right? They continue to go to the well. They continue to go to the well like it's free money until they get caught. McElliott mentioned today that he's seeing similar readings, extremes, positioning wise, very similar to Volmageddon back in 2018. Okay, that's a problem, right? So next Wednesday, VIX expiration, possible window, again, a window for uptick in volatility and some scramble in positioning, especially if there's negative news. Again, these are just windows of scenarios where things can possibly turn. Okay. What a lot of us are watching has been this here, right? Very similar to the COVID rally, which to me was a lot healthier, more of a true bull market rally with the Fed really involved. I mean, the Fed threw in the kitchen sink, obviously, off COVID. But very similar to the COVID rally, you had retail participation, but the pro side, the pros, right, who were aware of all the concerns out of COVID, the whole global economy is locked down, right? Who's going to go out of business? What headaches? We don't even have a vaccine. The smarter money out there was preoccupied with all the negatives and were reluctant to get behind that COVID rally. Okay. That lasted for a good amount of time until, if I remember correctly, I think it was the election. I think it might have been around the election, but they finally capitulated. They finally capitulated. You had hedge funds finally get aggressive on the long side. They had to because of performance reasons, right, and stuff like that. And then that set up for a solid pullback. Okay, we're still waiting on that. So here you have hedge funds in single names. Okay, up until just recently here, you could see they were just as short as they were back. Oh, not SIVB, but just as back as recently here. Okay, here's the zero line right here on hedge funds. Right? So to get to the area where you would see everybody in the pool, right? Everybody officially long, you would see something like this again. All right? You would see something like this where you'd see a spike into net positive exposure territory and they are on the long side. See, the problem is here, every sell off, every little dip, they're already caught offside, hedge funds. They're more likely to cover, right? Without some negative, extremely negative headline out there, okay? they're more reluctant to cover some of their short that they're caught in than add to their shorts, right? If they're already short. That's why you're seeing all these shallow dips, right? Any little sell bounces like a blue ball. Why? Because they're covering shorts into it. That and gamma, right? That's two powerful forces right there. So it's really difficult for the selling to pick up any momentum if a big chunk of the professional money out there is caught short and on the wrong side and probably are looking for an exit. Okay. And even more so if the market starts to run away from them or certain names start to run away from them, they need to chase. All right. And that adds fuel to the upside. Okay. So you're starting to see them cover shorts. And I think we can see that in the price action now as well. Why? Because it's not just the quote unquote quality names that are going higher, right? We see a lot of the high growth names, some of the heavily shorted names have been on an uptick. That's where a lot of this money is short here on the hedge fund side. Right? So we're seeing it play out in the price action. Okay. So that's what we're looking here on the positioning side. This is the only thing really left before you can make the case that, okay, everybody's in, everybody's long, and now it really doesn't take much to create some sort of sell off, right? The market could sell on itself, right? Profit taking can create a sell off, right? If everybody's long, no one's left to buy, correct? So you just get some profit taking, which snowballs into more profit taking, and the market could sell on itself. God forbid you get a catalyst, a reason to sell, and you get all that crowded positioning again, all trying to exit at the same time, right? So that's kind of the issue here. I think the good thing about, and I've been saying this, I think the good thing right now about this market, even with the stuff going bananas, is you can still get a read if there's any major issue that you need to try to sidestep, right? You may not sidestep it completely, but if you're prudent about things, right, and not chasing an SMCI all in at the highs and an ARM all in at the highs, right? If you're prudent about it and sizing down or letting winners roll and stuff like that, there will be signs that things are starting to unravel a bit. And you could take your risk down and get into a larger cash position if that's what you're looking to do, right? We can keep tabs on it. Obviously, the overnight risk is the main risk here. If something happens overnight out of China per se or geopolitically, right? You're going to get caught, right? But that's why I say you don't want to have a basket of names that look like SMCI and starting new positions here, because if you do get caught, you're going to give all that back, right? You're likely going to give back all the profits you made. So I think that's a good thing about, and that's why I think this market continues to trade the way it trades. It's almost like nobody wants to get spooked out of anything just yet until they see something to be concerned about, right? And what's the main concern here? Again, something we talked about this morning. And by the way, the revisions come out tomorrow. I thought they were today on the CPI. If you get an uptick in inflation, okay, and now the Fed can't rig the game, can't prop up the market as much as they would like in an election year, right? That would likely be a legitimate catalyst for people to take chips off the table. Right? So something like that's going to squash the current narrative out there before we see any real selling. Otherwise, we're going to see a continuation of this probably into next week. And again, we take it day by day as as some hurdles come around. We see how we react. Here's some of the other stuff. I think I posted a McElliott chart here. All right. So that fear of crash up, remember we were talking about this at the end of last year when we were talking about McElliott scenarios? Everybody, was thinking that they were concerned about the left tail. What happens if something bad happens? Let's put on insurance. That wasn't the main fear. The main fear on the street was what happens if this soft landing narrative becomes stronger? What happens if the Fed and Yellen is officially going to do the right thing for Biden and prop up the economy and market, right? We don't have enough long exposure. We're not positioned for that, right? So that was the mindset going into the end of last year. Players and funds, they were more concerned about the right tail, the risk of the right tail, than the left. And as more and more signs of that right tail start to manifest, right? Inflation comes in, um, Fed talking about rate cuts, right? Yellen doing her thing. You get that chase. And that's what we're seeing here. And so this is asset managers in US equity futures. All right. What's one of the quickest ways to get exposure to the overall market if you're underexposed? We see it in options in the futures market. And look at this. Right? I mean, this is pretty drastic. So, I hate to be the wet blanket, right? Especially with the kiddos out there who, they get all bulled up and the market continues to go higher, even when I talk about, when I throw out warnings out there just because they're not happening the next day, right? But the longer this goes on like this, the worse the ending is. You understand what I'm saying? The more that we continue to melt up and the more positioning starts to look like this, when it ends, it's going to be really, really ugly. It's going to be really, really ugly. Now, whether it's ugly in a violent, quick move that lasts a couple of weeks and beats the living shit out of everybody, or it slowly unravels that it's even more difficult to pick up on before the bottom falls out. But the ending to this, the longer this goes on, the worse it becomes, the more bearish the outcome. Right? So if you're bullish, right? If you're bullish, and those of you who've been in the game know exactly what I'm talking about, right? If you're true bull at heart, stuff that's going on in some of the semis and ARM, you don't want to see that shit. You rather not see that shit. What we were seeing prior to that was more constructive, right? The market, the buying slowly starting to broaden out into quality stuff, right? That's a healthy move, even if the indexes are not participating. That's a constructive, bullish environment, right? Focusing on profitable companies with that are showing growth, right? That's extremely constructive. When you start seeing this exuberance out there, right? Short squeeze names or names losing money, getting involved, or an arm that reports 25 cents for the quarter but is up 70%. That's not what you want to see. That's not what you want to see. All right, so it's gonna be interesting how this all shakes out, depending on when it does. Right, if it does sooner than later, I think that there's a lot of the market that doesn't really need to get beat up that much, right? Because it's not all of the market that is involved in this exuberance. But if this ends with it's spilling over into everything else, right? And you could see it. I'm trying to think of the year this happened, but I remember it vividly. Okay. You had the small caps were lagging, very similar to what we're seeing now. Okay. The market, the major indexes continue to push higher because of some of the quality, larger cap names. And the small caps weren't selling off, but they weren't participating in the upside. And then as soon as the small caps broke out and everybody thought that was the start of the broadening out of the rally and the start of the move, the market rolled over right after the IWM breakout. Okay. And that's what I fear here. Was it 2017? There you go. That's what I fear here is like everybody's waiting to see the breath, waiting to see the small cap participation before they think anything is quote unquote real, And that's what lures everybody in, and they get hit over the head. You know, so that's the problem. That's the problem I think here. You know, I want to see the small caps. You guys know I love small caps. I love not even small caps, penny stocks. I'm talking about the more unknown names out there, right? Now the names not everyone's paying attention to, but there's been a reason why the small caps haven't participated. The fundamentals in the small caps are abysmal. Okay, when your small cap indexes are made up of a GameStop and all this shit that's bleeding out money, and our market's focused on quality and real growth, there's a reason why they're not participating, right? Now, if they get involved here without the fundamentals, right, and that's what we're starting to see a little bit of, you know, that's just money forcing the issue in other areas, right? A reason to get in the pool, and then they usually get caught in its correction. Now, don't get me wrong, okay? I'm not talking about the death of the market. I'm not talking about um, 2008 all over again, right? That's a whole other story. That was a credit event, a major credit event, and is a completely different story. I'm just talking about um, a correction based off extreme positioning. And when that runs its course, that's likely the next best entry into a lot of things out there, right? But it's the inevitable. It's the inevitable. It's just a matter of time now. It's just a matter of time. So again, I'm not smart enough. I don't think anybody is to know when that's going to show up. And that's why I think it's still, if you're an active player, it's still worth participating. You know, still worth participating. If you see something's got enough momentum or catching sweeper activity and it's at a pretty decent spot, it's not up 100% in 2 days, and you see some aggressive buying coming in, you think you could get a 1-2 day move out of it, that's fine, right? You want to hold on to it a little bit longer, you're sizing down just in case you get caught, or you're putting on protection if you're a little too big, that's fine. Again, I'm making the point, you don't want to put the chips all in here, right? Especially names that already have made parabolic moves, because it's going to knock you out of the game. It's going to knock you out of the game, right? And as crazy as this market's been, there's been some spots. There's been some spots for tactical trades. And now you have the ability to roll or leave a runner, or right? We talked about like this name, Marvel, right? That came off a pullback here, downside niner. This is not a stock that's straight up 15 straight days. If you were interested in trying to catch a move here, or a TSM, which is, I mean, you couldn't ask for anything more than that, right? So, but as this continues to go, we're going to see, less and less opportunities with that risk reward for obvious reasons. This is not 99 2000. No, I wish this was 99 2000. Now, you can make the point that this is possibly 97, and we're going to end up going into a blow off 99 style bull market or rally. Okay, I have no idea if that can happen, right? That's a possibility, but you got to understand, okay, along the way there were corrections all over the place throughout the late 90s. Okay, by mid to late 99 into 2000, you don't know what took place. You see what SMCI just did? Times that by like 80, if not more. Okay, we went over this. You had a name like SMCI, okay, make a move like this, okay, then announce a 2-for-1 split. Trade to 1,000 off the split news, split 2-for-1. Okay, now it's at 500 again, and then go back to 1,000, and now it's another split. That was 99. This is nowhere near, not even close to 99, nowhere close. Okay, and in 99, you had blue chip names that were on fire making those moves, like some of you are mentioning, a Cisco or a Lucent or an AOL, or right, quote unquote, blue chip, WorldCom, Enron, and you had internet and chip stocks, okay, that were losing money. Some didn't have any revenue. Some didn't have any, they just added .com on their name and they went parabolic. 99 was a whole other animal, a whole other animal. And for anybody who's bullish out there, you could only hope you can live and be involved in another mid to late 90s style run because it was insane. Okay. But going back to the point about corrections, it sounds easy when you look back to the 90s. Okay. I lived through the 90s. I traded through the 90s and I was wet behind the ears trading through the 90s. Okay. Wasn't that easy to make money? The more you knew about the market, the worse you were. Okay. What do I mean by that? What happened was you would get corrections frequently. Every 3 months, you would get a legitimate correction in these stocks. Okay. So you would have, let's say, a CMGI, which was a high flyer trading at $400, that would correct to high 200s, right? 250, 300 pullback. And people would puke it up. They get shaken out of it. Oh shit, the rally's over. And then that stock would just rip to new highs, split, and go bananas again, right? So every correction was a buying opportunity in throughout that whole late 90s run. Okay. Ultimately, what it did though, it caught everybody and made everybody hold when the bubble burst in 2000 and they rode everything down to the ground because they didn't want to sell because it was the wrong move every other correction, right? But there were multiple frequent corrections throughout that late 90s run, right? So that's the point I'm making here, right? Maybe you're right. Maybe this turns into a late 90s style run. Okay. Very possible. I have no idea. Even if that's the case, there's going to be a correction that shakes out a lot of people, right? That's the inevitable. That's the inevitable. And that's the point I'm trying to make here, right? Whether you're bullish big picture or bearish big picture or whatever it is, okay, that's what we're talking about here. Again, it's above my pay grade to whether we go into some deep bear market that follows or the everything bubble pops, right? Everybody, we all thought that was 2022. Okay, I have no idea. I don't know if there's a credit event coming. I don't know the slightest clue. I don't have. Okay, all I'm saying is when you go from everybody on the sidelines to a point where everybody is all in now, there's usually a correction sooner than later. That's the only point I'm making. The only point, right? And that's the thing too. For me, I think that because somebody asked me this the other day, how do you know whether it's even worth getting involved, even tactically or not? And I think it's just almost common sense in a sense. Like you guys see, right? You're talking about newer setups that are working out, whether they're catching flow or a name that you off a pullback or consolidation and it's starting to build momentum, right? The more newer ideas you're seeing, right? The more likely that there's still some gas in the tank for it's still worth participating, trying to make money on the long side. Okay. If we get to a point where you start playing the same names, you're looking at the same names over and over and over again, not because you love them, but because there's nothing else to make money with, that's usually a strong sign that they're running out of gas. They're running out of bullets to fire. Right? But again, that what I just mentioned is all fine and dandy unless you get something that comes out of left field and throws everything off whack. And you can't say there's no shortage of bearish catalyst out there, right? Snap of a finger, something could go wrong in this effed up world, and rain on the parade here. I think now, just based off positioning, you you can't be surprised by that, right? That's the point I'm trying to get across here. If there's some sort of correction that does show up, right, and you get caught and you get lumped up, you got nobody to blame but yourself. You should be paying close attention to that now, right? You should have an idea of what you're okay with giving back, and that's what you're risking here. Stop worrying about how much money you can make because you didn't make enough yet in this move. All right? Be more concerned with, okay, if I get caught, I made X and X and X over the last few months in this rally. I'm okay giving this back. Worst case scenario. Yeah. Oh, Nvidia earnings. Good call, Abby. That was the other McKelly catalyst. I think I mentioned that. Nvidia earnings, possibly. Um, and I mean, listen, what you could get that complete melt up, and I think McKelly pointed it out, gamma wise, right, to 5,300. Maybe Nvidia knocks the ball out of the park, and that's that blow off right there. You know, but this is a positioning thing, and I know people think it doesn't matter, but if you think it doesn't matter, just look back on the complete opposite side of what we just lived through. Okay, including myself. Okay, including myself. There was literally nothing to be bullish about. Nothing, right? You had the Fed rigging the game in a bearish way. Okay, you had a global economy that was slowing down. You had the world upside down geopolitically, right? There was really not a reason, not a catalyst to get bullish or to look for any sort of bullish scenario, right? Everybody guaranteeing a recession was coming, right? And again, I'm not saying I'm any different. I'm in that same boat. I'm in that same boat. The last thing, and now that I think about it, being an election year, it's kind of stupid of me to assume, but I too thought for the Fed to be even talking about rate cuts, like there would need to be some economic hurt out there, economic pain. Like I just couldn't see the word rate cuts coming out of the Fed's mouth with a resilient economy and SPX 5,000. I could not see it. Now, again, you could give me the rebuttal to that would have been, well, Jesus, it's an election year. They're not going to, get in the way in an election year. Like that was a legitimate rebuttal for it, right? But I couldn't swallow that pill. I really couldn't. I just couldn't see it. But lo and behold, look, right? And nobody, the moral of the story is nobody was positioned for it. Nobody, right? Hedge funds are still not positioned for it as much as they would like to be, right? Nobody was positioned for it. And now we're approaching the other extreme, right? We're getting closer and closer to a reading at a positioning where everybody is now positioned for that. You understand? Everybody's positioned for soft landing. Everybody's positioning for rate cuts. Everybody's positioned for goodness. If something goes awry, if that doesn't turn out to be the case, there's a big, big problem. There's a big, big problem. So that's I think that's the edge, the main edge that comes out of sentiment and positioning, right? It doesn't nail buy sell signals to the tick, right? You could be early, you could be a lot earlier than you would like at times, but when there are turning points and positioning is all sides, that's where there's a lot of meat on the bone. That's where there's a lot of meat on the bone. As opposed to where we are now, we could see good news, right? But if everybody's already positioned for good news, it doesn't mean bullish price action. What's bizarre is my Twitter feed still groans when people say we can go higher from here. Yeah, and again, I think that's why we're seeing, what we're seeing. That's why I think we're seeing a lot of the craziness we're seeing. Is again, we see it even. Listen, I tried to stay away from Twitter because it it really gets in the interferes with kind of the read on sentiment, because I'll run into some jabroni on there who's spewing bullshit, guaranteeing shit to the upside, and I have one foot in my bunker. Or I'll run into a perma bear one day on FinTwit and I'll be like, look at this guy calling for a crash. This market still has upside. But these guys, they more than likely a lot of these guys aren't even really playing the game on social media. You know what I mean? They really probably don't even have real skin in the game, right? But we know, based off a lot of the stuff we look at, right, based off real positioning, that we could, it's still right, it's still the case, right? If hedge funds thought there was a lot more upside to the market, they'd be a lot longer than they are here, right? Not still net short. So there's still, you're right, there's still a crowd, there's still a crowd out there that doesn't fully believe. I think we're seeing the process of that change right now, the last stage of that. Let me get to, I see some interesting comments here. Uh, it feels a little like the COVID rally. It does. The reason I think it doesn't feel like the COVID rally for me is a lot of a lot of these signals that we've seen in the price action, the participation of the COVID rally, we didn't see initially here. Again, you got to understand how this move started. This move, right, the rally in a sense started as a defensive rally, crowding into the most heavily weighted names in the indexes, almost as a defensive posturing, right? Let me go into the market, buy some equities, but I'm only going to buy an Nvidia or a Meta because I still don't like the macro side of things. Right? So it was almost like, yeah, all right, let's get long equities, but in a defensive way. They almost treated this Magnificent Seven trade like a bond trade in a sense. Right? It was a flight to safety. Okay. That's how it started. And then very gradually, what started to happen, it started to spill over into other quality stuff, right? Not just those seven names. Now, again, like I said, a Costco or home builders, or and all the names we talk about ad nauseum on here, right? Profitable names, growing profits. They where the growth was, and because of the backdrop, there wasn't there wasn't many places that were seeing that, right, that growth. That's why the breadth was so poor. But little by little started to spread out, spread its wings, and now it's starting to move around into plenty of other areas, and you could see already, fundamentals be damned, right? They're now, who's looking for the positioning for a short squeeze, or this name didn't move yet, or right? It's not all based on quality and fundamentals now. Now it's speculation. All right. So the from the bottom to the reversal to COVID, you had everything. Like if you had a checklist, a blueprint for a bottom and the start of a bull market, you had it off the COVID lows. You had capitulation. You had all the offsides positioning that you needed. You had breadth, participation, new leaders, right? All of that right from go. You didn't have this. You didn't have that with this rally. Like, I don't think, I'll be honest with you, this didn't feel like a bull market to me up until recently, right? Up until really you got that Fed, that Yellen pivot. Prior to that, I mean, look. Oh, this is what the true market, right? The universe of stocks out there. The S&P 500, equal weight. Okay? This is what it felt like. This is what it looks like. Okay, as opposed to, if you want to take the bulk of the move, here are the Qs, right? Or even SPX, which is just not equally weighted. So you see the difference. And like now, right? Think of it, right? What new leaders of a start of a new bull market? Where were they up until recently? Now you can add some semis in there. Where was it? Meta, right? Nvidia. These aren't new leaders, right? These are leaders of prior bull markets, right? Off the October lows, the bulls, okay, the ones who deserve credit for calling the lows in October swore that the new bull market was going to be led by financials and value. Nobody was calling for tech to lead out of that rally. And you know what? They were right. Okay? They were right for a couple months. If you remember, tech underperformed. Amazon made new lows as the market bottomed and rallied off the October lows. And then financials got hit over the head. Cyclicals got hit over the head. Value stocks, small caps, you name it, couldn't get out of their own way. And at the start of 2023, big tech, Magnificent Seven, started to outperform, right? And then when the regional banks, SIVB, went under and the Fed and Treasury bailed out the banks, that's when big tech caught fire. So for me, to this day, again, my definition of a true bull market, I still don't see it. I still don't see it. Now, you want to talk about price action in the SMCI, I see it, right? It's one name. But aside from the semis, right, you don't see it. It was a crowding into quality. And no market has to be the same. I don't remember, I really don't remember anything as similar to what we're seeing now that I can remember in prior markets. The larger cap quality names being crowded into. But, listen, that's the market for you. That's the beauty of the market, right? You can see something new each and every day. But yeah, so, this has been what the overall market has felt like overall. All right, if you just look at Nvidia, it's felt a lot different, or Meta, or whatever name you want to put in it that's been ripping here. Okay, so that's the story. Again, I have no idea when these semis are going to run out of gas. They can continue to do what they do throughout the month of February. I have no clue. I have not the slightest clue. I have not the slightest clue. And I don't even know what the Fed is going to do in the interim. We're in weird times, right? Think of this. The market is not even concerned about New York Community Bank or any of these regional banks. They're actually, you could see it. NYCB starts to make new lows. The market, a little sell program will come into the market, and then they buy it right back up, right? It's almost like they say, oh no, the regional banks, there could be a problem. But wait, if there's a problem, the Fed will cut rates. You understand? So it's almost like they want the regional banks to burn so they can get rate cuts. Right? That too is something completely different than I'm used to. Right? Usually when the Fed cuts rates, the market, they don't care. They don't even care, let alone want them, because they're scared shitless. That's how ugly things are out there. You understand? So the Fed usually will implement stimulus, but the surrounding, the environment will be so bearish that people will almost ignore it. Think about the COVID lows. Okay? The Fed, global central banks threw in the kitchen sink, literally. You can't do any more than the Fed did into the COVID lows. Okay? They rigged the game to its fullest. They bought ETFs, for crying out loud, Japan style. You can't do any more than what the Fed did into the COVID lows. And nobody wanted to get long equities at that spot, right? How could you? You were locked in your house. There were tumbleweeds going across Manhattan, right? Everybody was scared shitless. How can you buy stocks when the economy shut down? You can't even get out of your house. Stores are boarded up. What are all these vacancies? What's going to happen with that? All these bankruptcies. What people were forgetting is that how can you go bankrupt if you had the unlimited tap of to borrow money as you wanted, right? Or you were getting checks in the mail from the government. But everybody was so spooked. It was so bearish. It was so bad that people couldn't see that through the fire. Here, you got something completely different. Here, the market's ripping based off the Fed talking about they're going to soon cut rates. Right? Here, you have the market, you got the regional banks, very similar to back in when SIVB went under, and the market doesn't care because the Fed is going to cut rates. It's a different animal here. It's a different animal. It's a different animal. Right? And I'll be honest with you, that spooks me a bit. It spooks me. If you're a contrarian at heart, you don't want that. Right? The old saying, buy when blood in the street. You want a scenario like the COVID lows. Right? That's where you feel comfortable adding exposure and continuing to add exposure, right? For longer term. Because everybody's out of the market. Everybody's sold. Everybody's bearish. You got that wall of worry to continue to climb. Because the Fed is backstopping everything. Here it's like everybody's relying on the Fed backstopping. Everybody's aware of it. What spooks me is what happens. There's something that Fed backstop can't really help, right? Now you got, instead of everybody out of the market, you got everybody in the market because of that Fed backstop. So, legendary Billy Walters tells us he's going to make a small bet on the Chiefs in the Super Bowl of $500,000 to $1 million. He thinks the line is 4 points. Billy Walters. He was my idol growing up, Billy Walters. He was my idol. He dabbled in the market too, and then he got out of it. He couldn't handle it. He went right back to the bowl games. Mortgage defaults went from 2 to 5% in the great financial crisis. 3% was not enough to cause a crash. Yeah, I didn't, it's funny. Who's that? Costum? Yeah. I never thought, I really wasn't a believer that the market was going to crash off 2022 because positioning was so bearish. Right? Everybody was looking for it. Everybody was looking for a crash. Everybody was looking for a recession. What I really thought, what I truly believed at heart, was kind of Druckenmiller's scenario, where this, and it's still possible here, but not on the NASDAQ and the S&P, but just to give you an idea, where we would do this for a lengthy period of time, and that would wear out everybody. You understand? Because, and the reason why I felt that is, just look around you right now. Do you think 2022 really cleansed the speculative behavior that was out there? I mean, you got risk on for a month. I look at social media, you got people, all kinds of scams they're selling, who's showing account statements. They took an account from 1,000 to 100,000 in 2 days. You're seeing all the stuff that you would see in 2021 again. You're starting to see, right? There wasn't a legitimate cleansing out there. Maybe on the professional side, in Europe there was capitulation. Everybody ran away from any Europe exposure, right? But here it wasn't. So the last thing I expected was the Fed to do what they're doing right now without really any catalyst, right? Without any reason to get dovish and to look to cut rates. Um, and another bubble brew because that's what's brewing. That's what's brewing. All right. And listen to me. Okay. It could be the market that we're in too, where it just prices everything. You guys know. Okay. I was a bull on SMCI just as much as any of you are now. Okay. And even when SMCI after this run, based off the numbers there, I felt it still was a legit name. Okay. Based off the fundamentals. All right. This wasn't a sexy EV story. All right. It wasn't a SPAC. It wasn't any shit like that. It was based off fundamentals. But this now, right? I get it. It's still cheap based off these numbers, but that's not the point I'm trying to make. Is that everybody is positioned for those numbers now? Everybody, right? It's getting priced in. All that good is all getting priced in now. Right? What's left to be priced in after that? You understand? This being still cheap off of earnings is getting priced in right in front of our eyes. Done. That's already priced into the stock. Right? So what usually this would occur over 6 to 9 months or however long, right? Up, come down for a couple of weeks, new highs, come down. It did it all literally in 15 straight days. 15 straight days. All right, that tells you a lot. Oh, who did that? I got hacked. That tells you a lot about the sentiment out there. Tells you a lot about the sentiment out there. Price action like that. Even in a market where some of the indexes aren't even doing anything. So that's the only the price action is what about the what's wrong? Say they have not priced in unicorn tiers yet. What mortgage that 10,000? Well, I mean 1,000 Ranchero wouldn't surprise either of us, right? Nothing surprises me anymore in this market. Nothing. Nothing. And honestly, to Ranchero's point, he's been making over and over and over again the last couple of weeks. If the music's still playing and they continue to play dips and you want to trade this thing tactically, why there's no reason for anybody to tell you not to. There's no reason anyway, right? The momentum's there and they keep giving it to you. What were you saying here? What about the miners? Yeah, well, what about the miners? I mean, maybe they play. Look, a lot of these cyclical spots just nobody wants to own them, right? That's just the attitude out there, right? Give me the next hot semi. That's the euphoric attitude right there, right? Why the economy's strong? No, right? Freeport can't get out of its own way. Cyclical name, right? Like the stuff that would rally based off of strong fundamentals of the economy and stuff like that, they still can't get it out of their own way because it's tough out there, right? And you got inflation crashing on top of it. But whatever up to this point, right, where we're seeing now the Carvanas of the world get play, the Affirms and all the bullshit, right? Up until recently, I told you you give me any name that has been in a strong uptrend. Forget about the SMCI move over 14 days. Okay, let's take Ranchero's baby. Okay, this, right? And here, the circle's still there where this started. This didn't start this month. The rotation into quality names has been going on for a bit now. It's just been broadening out because there have been little by little more and more names to get involved in that meet that criteria. But these, all of them, have ridiculous numbers, right? Profitable and growth. Right? We've been running that scan every week to see what names are on there. I'm trying not to jinx her, but yeah, listen, this too. Look at the move here, right? This is this is insane. This is a strong ass move here. Again, this is a legit name. I'm not saying I think you buy, as Ronchero would agree, you buy corrections in Costco, right? But that doesn't mean it can't. It's not going to get to a point where it's going to run into a correction. The best of the best will. But give me any name. What are the names, right? Even some of the here they spread out right to some of the growthier names we were talking about, like an Annette or like this VRT, right? Look, but now they're all in the clouds. They're all in the clouds, right? That's where like the SMCI started from. All these type of names. We're in a lot of them. PAR, the cybersecurity names, right? Here, let me piss off Ronchero here a little bit. Right? These names are nuts. Right? Profitable growth and sexy sector. Right? Can't get a better sector than this. They're insane. And even some of we saw like what's the Berkshire Hathaway we've seen recently? Is that Dot B? Right? As the financials haven't done anything. Right? So they're picking certain spots where the fundamentals align with growth, and all these charts are up and to the right. Now you got now you're getting some shit involved. Even this, right? The fundamentals have been we talked about this has been on the growth scan and seen nice flow. Right? And this is, kind of in that underbelly, not no mega cap or magnificent seven. All been acting well. So I think, hey GJT, I think when the correction comes, you want to. That's the thing. You want to look to these names, these quality names again, because I think those are the names to buy off the correction, as opposed to the hype names. Right? These are the names that are going to find dip buyers. Okay. But the my biggest concern is this goes on for longer than I hope for, and it just makes things worse. The end game worse. I don't know what the end game can be if this thing goes on for a lot longer. You don't want to get to that point. We're running close. If we could get a nice violent washout sooner than later, I think that would be the best thing for bulls, the best thing. But you see each and every day that goes on, right? SMCI goes up 14 straight days, and ARM reports. You know, the last thing I thought ARM would be up 60%. Maybe I'm a little bitter because I was hoping for a pullback in it. You know what I mean? But I mean, come on, you know what the fuck is that? Oh, this name too, right? I know Ranchero, you should like this name as well. ASML. I mean, look at these numbers, guys. This is no shoe shine company here. Look at this. Big numbers. Big numbers. So, yeah, we'll see how it all shakes out. We'll see how it all shakes out. By the way, cash and this flow into cash, I think the highest ever again this week. Money going to cash. There's a lot of money going to cash here. So there's money on the sidelines to buy things. Kathy Wood dying to yeah. And listen, I don't want to hate on her. Maybe the lows are in. She's got a lot of junk in there though. She needs Fed liquidity. That's what she needs. She needs help from Powell. By the way, the Fed today's Thursday. Fed balance sheet come out yet? I don't think this updated it yet. Let's see. Let's check it out. Did it update? No, I don't think so. No, I don't think it updated yet. We'll see. Bitcoin, though, Bitcoin showing this uptick here. Looks like, what the fuck happened to my charts? Kathy Wood, yeah. What's her main holdings right now? Anyhow, they're Tesla. Was it Roku? Tesla, Roku, and what's the other one? I mean, some of our go-to names have been obliterated. I don't know what her current big top positions are. How? Yeah, there's you, the thing. It's a. I understand what you're saying. Like Chuck is saying, how is it even possible that cash is still going to the sidelines? Prior to just recently, Chuck, there really hasn't been like if you look, let me show you. Hold on, let me see if I can dig it up. Give me 1 second. I'll show you something you'll find interesting. Hold on. Um hold on, give me 1 sec. Something we've been looking at every week. Oh, here it is. Okay. Look at this, Chuck. Okay. We talk about like hedge funds a lot, right? What this is institutions, right? The blue line. Long onlys. They don't short. Okay, so all they're doing is getting long names, right? Those institutions, what do they like to buy, right? You ever read IBD is still around, right? Ever read IBD? I think they had a section on it, right, talking about institutions like to buy companies with growth and profitability, right? They got that can slim method based off that. Okay, so that's what they focus on, right? They want to buy quality, but there's been such a small pile of quality to choose from that this is long only funds net buying since the bear market started. Okay, January 2022, they've been taking down exposure literally all the way up until recently, late last year. And if you remember late last year, remember financials got involved, cyclicals got involved, Caterpillar, right? We started to see more involvement of that quality sector. Okay. That was this buying here. Look what they've done even recently here, Chuck. All this, right, has been going to cash. They're not shorting. They're not shorting. They don't short. Right? This is hedge fund net exposure. Right? So they go long, they go short, they hedge. Right? This is the long only institutions here. Right? So the more that the quality basket builds, you'll start to see this, go in the other direction, right? But they've been raising a lot of cash because there's just not a lot. There's not a lot to buy. We look at it as maybe a lot when you're running billions and billions and billions of dollars. Yeah, there's only so much Nvidia and Meta you can buy, right? But you see the other names too. This guy, right? This is not Magnificent Seven, but this is a stud. I mean, this is a stud now. These are stud names. Coin, Tesla, Roku, Square, Zoom, and Path. Those are the top things, Dan. Jesus. I mean, Coin Tesla, you can make the argument for Coin Tesla, right? Maybe. But Roku's got headaches. Even though they've been doing better. I think Roku's losing all sorts of money, aren't they? They're not profitable, I don't think. No way. No, they're still losing money. But that's her style. She likes to buy eggs before they hatch. And then if she has a couple of them hatch, or she has a situation like post COVID where the game gets rigged and there's so much liquidity that people would buy anything, she hits it big. Otherwise, without the Fed liquidity, right? Without central bank liquidity, you see more of that quality factor at play. I mean, that's again, not to sound like a grandpa sitting in my rocking chair again, but that's the true physics of the market. You're buying shares of a company, right? You buy shares of it. The better the company does, the more the company grows, the more money, right? They make, the more profits they generate. Shares increase in value. Right? This has become straight up gambling now. The stock market from its original starting point, right? But that's like, that's the basics of the market, right? So when you don't have the Fed rigging the game and getting involved, that's what you see, right? A lot of you guys, and I don't blame you for it. You think fundamentals? Who cares about fundamentals? Because that's what the markets become with the Fed involved. Nobody pays attention to fundamentals anymore as much. But when you get into, you know, normal market environment without the Fed involved, that's what you start to see. You start to see fundamentals matter again. And that's what we were seeing, right? And again, there were not a lot of names. It was thin, but there was a reason it was thin, right? Because it was a tough economy. Not many companies can grow in that circumstance. But it started to broaden out. Now with the Fed and the Treasury helping prop things up in an election year, you started to see it loosen up a bit, and that's when those casting names work. What's a fundamental? Exactly. But ultimately, like for investing purposes, and that's a whole other topic. You want to invest, where fundamentals are, right? Stories. What happens? A story, you can get a trade out of a story, but over time, the story doesn't last. If that story can't turn into profits, it goes poof. Right? Look at any of the EV names. Look at any of the SPAC names, skills, every single one of them. Right? They had sexy stories. Oh my God, the EV stocks. Every single one was a sexy story. Right? They all went poof. Right? A lot of them will never come back. But the names that show fundamentals and they stick around. That's why this thing got hot recently. You had a little combination of the two, right? They've turned profitable now, so that story's coming to fruition, and you got a better liquidity environment. Yeah. Again, for investing, I guess they're making Sahil, they're being sarcastic. For a trade, it really don't matter unless you're in an environment that we've been in, right? Where only quality really gets bought. But that's the story. These Bitcoin miners got hot the last couple of days because of the strength of Bitcoin. Now you got Bitcoin moving. What's that telling us about liquidity? We're going to see another, maybe a couple of regional banks are going to go under. Okay. Did I miss anybody else's question before we wrap it up? All right. The moral of the story here, guys, is that we want to continue to be involved in some sort of fashion, right? Even if it means being extremely nimble or extremely light, because it's worth it. We see it's worth it. There are enough names involved. The moves are still there. If that starts to thin out, could be a warning sign. But the bottom line, listen, if you're in the steam room, we are going to keep tabs on all those warning signs on a daily, right? I always update you guys on what credit is doing. By the way, look at credit default swaps, because I know some of you come on here asking about it. I mean, this tells the whole story, right? This basically is screaming Fed put. Now, if that changes, we'll be aware of it, right? But this is pretty psychotic here. Let me take it from the beginning of the year. So here's credit default swaps, right? We looked at this throughout the bear market, and now, honestly, it doesn't pay to look at it until I give you a heads up that something's going on. Because it's not saying anything right now, but risk on. Look at this. Right here. Okay? Like I get it. There was some bullish action, especially in a few spots here. Right here, something changed. You see that? Risk got completely sucked out of the market right there. All right? You see how this was kind of like range bound and very similar to the market being range bound, especially the equal weight. Okay? Why? Because the Fed didn't pivot. The Fed was higher for longer, right? They were doing their thing. They weren't going to open up the spigots. And then into these lows, started with Yellen, that all changed. All right, that all changed, and the bottom dropped out. All right, risk completely sucked out of the market. Now, what changed fundamentally there in the fundamentals of the economy? What changed? Nothing changed. What changed was the credit market, right? And the signals from the credit market were indicating that there's sort of a Fed put at play. Right? If something goes wrong, okay, they're pricing out risk, thinking that the Fed and the Treasury are going to limit the damage. And same thing happened off of COVID. Okay, you had COVID, right? People dropping dead from COVID all over the place. Economies getting shut down. Okay, credit default swaps exploded because they were pricing in risk. Right? How many companies are going to go out of business if the economy shuts down? Right? Everybody. But when the Fed took action, right? Central banks took action. Credit default swaps rolled over in a big way, just like they did here. Okay, they sucked all that risk out of the market. Why? Were there any bankruptcies coming out of COVID? Nobody went bankrupt. There were no bankruptcies. Right? Even with the economy shut down, even with no vaccine or anything in the picture, because the Fed had their back. There it is, the QRA exactly, son. Exactly. That's the exact day, the QRA. Yellen, right there. Bink. And then the Powell pivot came up here. Right there, nailed the lows, Yellen, with that QRA. So, that obviously, was keeping risk in the market, right? The credit market was concerned about that enough that whatever Yellen did that day wasn't concerned anymore. Right? So if this NYCB ends up blowing up and causing a stir and it starts spreading, right, you're going to see these things widen out, meaning push higher, if the credit market is concerned that there's a problem. Right? If you don't see that, ignore all the noise around you because the credit market's telling you it's no big deal. Why is silver uncorrelating from gold? Now, the only reason I would know this is because I was curious about it once before. Silver is more tied to the economy, is what I understand. You understand? Gold is kind of a play off the Fed printing money, the dollar weakening, and stuff like that. Silver has strong ties. It's economically sensitive. So if the economy is kind of stagnant, it would weigh on silver underperforming gold. Is again my understanding. It could be something completely different today. Why it's underperforming, but that's the only reasoning that I know of. I don't know anything else besides that. LQDIEF. Well, LQDIEF is basically a proxy on corporate bond spreads, not credit default swaps. So this, let me show you. Hold on. Oh, okay. So that LQDIEF we look at is more of a read on this, not default swaps, on corporate bond yield spreads. That. So more company specific, right? Certain bond specific. Because you have this too, right? This is high yield spreads, right? So they're different bond spreads, different type of bonds, right? Like this here, you got LQD. This is LQD. See, it was down today. And let's see, HYG was flat today. You understand? So they traded a little different today. I think that's why it was off correlation. But again, we want to, for picking up on signs of a problem, you more than likely you will see credit default swaps react. The signs will come from there first. Sometimes they could come from here first, but a lot of times problems, an issue can come from here first. But again, I just like this today, the divergence between like LQD and the rest. I mean, look around you. The market, right? Look, ES was flat today. You know, like it wasn't a huge up day. I felt like today was a huge up day today with some of these names, but it was the semis and some spec names. As far as the market's concerned, the market didn't do anything too special today, right? And look, the true market kind of has gone nowhere here since December, right? But we may see that catch up here. Very possible that we see a catch up here, like we were saying earlier, right? And that's what gets everybody to finally believe in this rally on the professional side. All right. Anybody else? Did I anything I didn't show, or any questions or anything like that? Yeah. Sorry. I'm glad. My pick was spot on. Ask me if I own any of it. I don't own shit. I don't own shit. Again, that's just the bubble play, Adrian. Like if you think this melt up has legs, it's probably going to come from Soxel. The A correction won't change that. Correction won't change that. I don't think a correction changes that at all. If we get a correction, I still think, because probably set up a pretty decent entry on a lot of these quality semis. The problem with it is I can say that, but who knows what happens? I don't know what happens. You know what I mean? Putin could fire a nuke into my backyard next week. How am I going to forecast anything like that? I have no idea. That's why it's so difficult right now to try to even attempt to forecast anything, and just be reactive. Right? Not to beat the dead drum over and over again, but if you can sit back and like read the signals and react to it, right? Sometimes you're going to be too late. You may be a little gun shy, or you may not get enough of the upside. Other times there'll be more meat on the bone. but I think it takes a lot of the risk out of the equation and can keep you involved. You'll get paid if you try to front run a move, but you see how difficult that is. Even when you're right, your thesis is right, you could be wrong, owning the wrong things. It's really tough, guys. Don't let anyone bullshit you. It's tough. Now people think it's easy because they're buying semis that go up 14 straight days. Right? When they get bulldozed there, they'll be talking about something else. Hedge funds, Sahil, are still net short, but we're still on a little delay. In my opinion, I think we're seeing right in front of us them capitulating, right? So we'll see how long they end up. But there's still room, right? There's still room. There's still room, and in the futures market, there's still net short S&P futures, so there's room there. But there are other things that are really heating up, Sahil. Like, look, like this is what McElliott was pointing out earlier. You know, if there's a trigger right now, there's likely going to be a violent sell. You got this. You have the systematic CTAs that if there's a trigger to start some selling, they're going to start selling. You got the VIX stuff that's going to add fuel to the fire, right? That's the key, in my opinion. This, right? The VIX, and even more important, oh shit, what am I doing here? This, okay, which has been creeping up a little bit here, right? If and see, I got that $100 mark right here. If this VVIX starts to find follow through, right? So more than likely, it's going to take something for VVIX to find follow through, meaning that there's a real interest in VIX, right? There's a follow through in VIX, something like this. You get something like this startup right here, and there's gonna be some violent sell, especially in a lot of things out there. Feb OPEX is a window. McElliott was thinking Sahil it could carry into March, but now he's even getting concerned. Again, he's making the point that we were making. If there's a negative catalyst that shows up, you're going to get something Volmageddon like here. You understand? You need the trigger still here, but if you do get that trigger, you're going to get some Volmageddon move. So that's the concern. When you have moves like these, they have to cover what? Yeah, exactly, Constant. That's exactly it. Right? So, and think of this too, right? The CTAs, the systematic trend followers, okay? There's no emotion there. They're not like us that we're like, oh, I'm supposed to buy, but I'm not going to buy. There's no emotion. They solely buy and sell based off levels, right? So, what happens is right now, those systematic funds are very long, okay? They have a lot of long exposure. They've made a lot of money in this market. Okay, because once the VIX broke downside levels and S&P broke upside levels, they didn't even think about it. Right? They just aggressively up long exposure. They sell VIX, they get long the market. Okay, so now it's got to the point where they're fully loaded. They got a lot of long exposure. If the VIX starts to break levels to the upside, they automatically are going to take down that long equity exposure. Not if, guaranteed, they take down their long equity exposure. So as VIX breaks levels to the upside, and as the S&P starts to break downside levels, they just unload and sell off that long exposure. Okay, and you can see how that could end up cascading into a violent move, especially when you got other stuff like this fully loaded as well. Right? So all of a sudden you get in everyone where we're just, piling into longs. Now they're all in. Now they got to start unloading those longs and putting on protection, right? And market makers have to hedge that. It snowballs into disaster. That's what happened with Volmageddon. It happened so quick that you just you had this blink of an eye move, and here you guys remember some of the VIX products that went under. That was 2018, and this is what it looked like in the price action. Right, wasn't the end of the world. Right, I mean, obviously, wasn't the end of the world, but you didn't want to get caught heavy-handed long into it. I'll tell you that much. Right here, see this move? Okay, so this is what the market did. Up, 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 up. We're never going down ever again. VIX keeps selling, la di da di da. And then I don't even know what the trigger was. You guys probably know. What was the trigger? Anybody remember? I was just saying that. I don't even remember what the trigger was. But anyway, you could see, right? Look, one little gap down overnight. And bloop. See how fast that happened? Look what it gave back, guys. This whole entire move in a week. All of it. Now, look, okay, I remember it like it was yesterday. This setup was a pretty decent setup because you had one extreme to another. By this low here, everybody was bearish again. Everybody. Okay. If they didn't get shaken out here after this bounce, they got shaken out here. Everybody was bearish. And then look at this nice, healthy uptrend after that. You understand what I'm saying? So I'm not talking about Armageddon. It doesn't have to be Armageddon. But let me tell you this. If you own any of those calls you're playing right now and you get caught in this, zero. That's what you're getting back out of those calls. Zero. You understand what I'm telling you? Zero. So whatever you're risking, that goes to zero. And if you're risking what you made here, you give it all back. Plain and simple. That's the point I'm trying to make here. Kalanovich was the trigger? Stop it, Oppie. Are you being sarcastic? Oh, Fed repo? I don't remember. I'm asking you guys. I can't remember. I'm pretty good with the memory, with the market, but I can't remember that. 2018. Because 2008 was 18 was a funky year. Because look, you had Volmageddon at the start, and then at the end of the year, you had this disaster, which was worse, remember? So it was a crazy year, 2018. I think taper tantrum. Yeah, so I don't remember. But that's this is it here. All right, so when you hear McElliott talk about Volmageddon, this is what he's talking about. Mike Wilson, yeah. No, why? I thought it was just they gave him a different just a different title, I think, Sahil. I think. Trump China. Maybe it was Trump China. Could be. I honestly don't remember. And guys, who knows, right? Could have been nothing. Could have been the stupidest shit. Maybe it was the repo. Somebody mentioned repo. Maybe it was that. But when you get, positioning that full, here's what VIX did. All right? So look at VIX. Okay, here's VIX. Oh, wait, I don't know. I don't want to show you that yet. Here's VIX. Okay, every pop getting sold, goes to new lows, $9, right? Or trying to break new lows, and a little bit of ping, 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 ping. There it is. So what happened was, and this is something else Mick Elliott points out, you see this? Sometimes this could be an early warning sign. You see how VIX started to go higher with the market? So VIX found the bottom and started to trade higher a little bit with the market. with the market going higher as well, and then exploded. But look at that. Before you blink, look at this. Before you blink. All right. So again, like always, not to sound corny, make sure you're paying attention to what you risk, but it's okay to give back some money, right? Take a loss. It's all fine. You just don't want to get caught and knocked out at this point, right? And we'll see how it shakes out. All right, my friends. Yeah, selling because exactly. Just like same thing on the upside, right, Abby? It's just right. People sell, market makers hedging, right? People taking down exposure, indexes break levels, that brings on more selling, margin calls, this, that, everything snowballs. And this in this market, that's the one takeaway. Like if anybody asked me the difference between this market and even you know a few years back, the moves are so quick. Now you don't even have time to think. If you see something that you see an edge fundamentally, you have to react if you want to catch it, right? If you want to catch that move, because you blink and it gets priced in a snap of a finger, right? Either that or you got to be okay with chasing, and that's my problem. I can't. I hate chasing. It's just I don't feel right chasing. You understand? It just in my the way I'm wired, and I miss a lot of. Or you see all the shit I miss. It's so annoying. But that's the problem. These moves are so damn quick, so you got to be on your toes. Yep, guys, always a pleasure. Thanks for stopping by. Enjoy the Friday. I'll speak to you guys in the morning. Anyhow, enjoy the rest of the night, everybody.